And what I'm here to do today is introduce Jay Jordan. It's my great pleasure to present him with the ACG Lifetime Achievement Award for this year. Jay is the managing principal and chairman of the Jordan Company. He's obviously had a very successful career, and one of the most important things is he's been an incredible supporter of the ACG. He made sure I got into it when I joined Jordan Industries in 1988, so he's got everybody into it, and obviously with Andy Rice there, who's going to interview Jay here, we've supported, or Jordan has supported ACG for years. Jay comes out of Kansas City. He went to Notre Dame and graduated in 1969, and from there he attended Columbia Business School, and from there he ended up at a firm called Karl Marx & Company, which I think is a wonderful name for a capitalistic investment firm. But I hear it has a C and it has a different ending, but I always was struck by that. And at Karl Marx, he had a group that was the leaders and the pioneers of what we used to call the leveraged buyout industry. Then they cleaned it up, and now we call it the private equity industry. And as everybody remembers, it used to be a lot of L and not a lot of E back in those days, but that was one of the pioneers. In 1982, Jay founded the Jordan Company in New York City, which is now a global private equity firm. In 1988, with a friend of his named Tom Quinn, they founded a industrial conglomerate private equity in Deerfield, Illinois called Jordan Industries, where I met Jay and where I met Andy and Tom. But one of the two biggest things that the Jordan Company's done in the last decade is in 2002, I should say, they raised $1.5 billion in what they called the Resolute Fund 1. And in 2007, they raised $3.6 billion in Resolute Fund 2. Excuse me, if I had a podium up here, I'd be not doing this, but it's tough to see when the lights are going at you, too. TJC, the Jordan Company, now has more than 15 platform companies. Jay, over his 38 career, has been involved with some 100 platform acquisitions and some 500 add-ons and joint ventures. It's an amazing record. It's no question about it. One of the more important things, and obviously with Andy and Tom's help, the Jordan Company, Jordan Industries, was one of the first private equity firms to go international. Back in the early 90s and late 80s, the Jordan Company, Jordan Industries, began to get into China, began to get into the Middle European areas like the Czech Republic and Slovakia. They got into India, they got into Russia, long before most middle market corporate companies were there. They were forming international investments all over the world. Jay is on some 40 boards. That's a lot of boards, I'll tell you. The Art Institute of Chicago, Lyric Opera, and Notre Dame amongst them. And he will be interviewed today by the SVP of the Jordan Company, SVP Andy Rice on the international side. Andy is a good friend of mine and one of the people you want to travel with. Andy has the ability to get along with anybody, anywhere, in any part of the world. And if you are ever playing tennis, you want him on your team, especially doubles. But Andy graduated from New Mexico State in 1978 and graduated from New Mexico State with a combined MBA and Master's of Science and Engineering in 1989. Before Jordan Industries and the Jordan Company, he did stints at Ameritech, IC Industries, and Pillsbury. And again, he is on the international board, as I see it, of ACG. So he's very familiar and very supportive of this whole group. With that, I'd love to bring Jay up and present him with the Lifetime Achievement Award for ACG Chicago.
I use this here.
I think Andy's going to use it.
Let me put this down. Is the mic on here? My mic on? Yeah, okay. Anyway, Jim, thank you so very, very much. That was very nice of you. I also want to thank all of my friends and partners and associates who've come from around the country and joined us tonight. I'm a little bit surprised because I always thought Lifetime Achievement Awards were for people that had passed away. Obviously, that's not true. And I also then began to recall that, well, maybe these Lifetime Achievement Awards are for folks that really kind of old and worn out, never did anything, but everybody feels sorry for them. So here I am tonight. Andy feels sorry for me. I'd like to thank the ACG for this great award. I started back with the ACG in the mid-'70s, I believe, 75, 76, when it began in Chicago, actually. And I remember Tom Smith, who was a partner at Ernst and, what was it back then? It wasn't Ernst and Winnie, was it? Okay. And he got me involved in the ACG. And I must tell you, throughout the building of our collective careers of our partners and folks associated with the Jordan Company, the ACG played a critical role in helping us build our business. Because we were focused in the sort of the lower market, small cap, mid cap markets. And we didn't do business with Wall Street. We like to say we bought on Main Street and sold on Wall Street. And there were a group of loosely connected folks in the financial services industry, professionals, non-Wall Street professionals, that came together to form this ACG. And they were extremely helpful to us in finding and locating companies that we could buy. So over the course of my career, and this started when I was at Karl Marx, and it's been 35 years, I would say ACG members were responsible for at least 60 to 70% of all of our acquisitions. So for that, I want to thank you. I think this award is wonderful, but more important is it's provided great careers and great opportunities for all of our folks associated with not only Jordan Industries, but the Jordan Company and what have you. So thank you very much.
First of all, is this on?
There it is.
Is it on now? Okay. Jay, on behalf of all of us at Jordan and your other friends, I'd like to also congratulate you tonight. It's an honor for you and our company. And I'd also like to congratulate Redbox and Venergy. Very interesting stories. Jay, I'd like to begin by expanding on what Jim talked about. When you finished Notre Dame and Columbia Business School, you chose to work at Karl Marx. My understanding is you also had opportunities to work at Goldman, Morgan Stanley, and other large investment banks. Why did you choose Karl Marx?
Well, obviously, you know, the Goldman and Morgan Stanley folks and the big investment banks back then, they hired a lot of associates, and you were really just a number. And there was no individual identity. They're very institutional. Karl Marx basically was a great place. And the only way I got a job there was I had heard about them, and I sent them this hyped-up resume. They were looking for a partner or junior partner, and I was just a lowly associate. But if I looked at the resume today, I'd be totally embarrassed and ashamed to have put all this stuff down there. But it was actually true. And I went down and interviewed and tried to convince them that I was the right person. It was very entrepreneurial. It was a place that I belonged as opposed to one of the big name companies. And I remember when they decided, well, maybe we'll take a shot on this guy, we started talking about compensation. And the two principals, a fellow named Ian Cumming and Joe Steinberg, who were hiring me, said, well, we think $50 a day is more than appropriate. I looked at him and I said, well, guys, I don't know if I can pay you 50, but I can pay you 25. They hired me instantly. And we just took off from there. So it was a very entrepreneurial place. I had a desk and a phone, and that was just about it. I started out in their venture capital side of the business. They were at the time in venture capital, old-style venture capital, not the highfalutin stuff you have today and the technology and stuff, just basic stuff. Growth equity and real estate. And so I started, and you'll excuse the expression, but back in the old days, you know, shit flows downhill, and I was at the bottom of the hill. So I caught all the nasty stuff and all the workouts and all the bankruptcies in the venture capital side, and I thought it was great because I was learning. And I then began to develop I had a good friend from Columbia Business School who was working at Bear Stearns under Jerry Kohlberg and Henry Kravis. And he was doing what they called bootstraps. And I had no idea what a bootstrap was, but he showed me one of their PPMs or one of their investment memorandums. And basically, they were buying basic companies and leveraging them. And it seemed like a great business. So I talked the partners at Karl Marx into letting me try to do this. I was out there by myself. They probably figured they'd give me enough rope to hang myself and I'd be out the door. So, but it began to work out, and that's how I got into the buyout business. Karl Marx. I think we bought about 20 companies, and most of which came from ACG members, and then we went from there with the Jordan Company and so on. So.
Jay, as you've grown the Jordan Company over the years, how have you and your partners differentiated TJC from other private equity firms?
Well, number one, we were in the game early, which makes a big difference because you establish relationships. And the marketplace that we work in, it's all about relationships. We were very entrepreneurial, and we had built a cadre of folks that were bringing us transactions, and we were sort of their buyer of choice. That was extremely helpful. We collectively, and as we began to build the firm, and I was there, I founded it, but I was not individual or totally responsible for building this firm. There were a number of great contributions by a number of great people that are all partners today and the principals today and what have you that all contributed in some capacity to building this firm. But we stuck to our market when everybody went upstream, like KKR and Fortune Little and what have you, Bain and Tommy Lee. They all went up to mega stuff and much larger. We stuck to what we knew. So we were very tough competitors. We were the most experienced competitors in the market that we served. And and we were very entrepreneurial. A lot of experience. People talk about, you tell your kids about experience, they don't believe you. But I got to tell you, we have a huge advantage with a lot of experience, particularly in today's climate. I've been through 5 cycles. And so, been there, done that. And many of our partners have been through 4 or 5 as well. So we're prepared to deal with whatever we have to face.
Why don't you talk a little bit about the operations management group that you and Tom Quinn have put together?
Well, I didn't put together anything. The only thing I did was bring Tom into the firm as a partner. He put the whole damn thing together, and he ought to come up here and answer that question, not me. But the reason that we got into this initiative is that throughout the early 80s, we were very successful in spite of ourselves. It was like Disneyland for adults. You could not be successful in this business in the early 80s unless you had an IQ below plant life or something. And we just barely got above that level, so we were successful. But I kind of thought, this was going to come to an end. This is too easy, We're not adding any value here. This is all a bunch of financial engineering and arbitraging markets and that kind of stuff. We got to start adding value. And we got to find somebody that knows how to do it because we have no idea how to do it. So Tom and I were roommates at Notre Dame, and he had a great career in the corporate sector, and he really knew this operations business. We knew nothing about it. So I convinced him that, hey, why don't you come on over and just run these things, and make sure that we don't screw up too badly, and when we do, try to fix it. And since then, we were the first, I think, to get into this operations management group, or operations management. And today, we are truly embedded in our private equity business. We are one of the few that really has one. Now, you have a lot of folks that claim they do, but they really don't. But we actually do. And Tom has run that from day one and done a great job. And particularly in today's marketplace, when things are going wonderful and the economy's flying off the charts, capital markets are robust and liquid, the OMG, we call it, isn't as active or as productive. But today, and I will tell you this, right now we have a massive, large portfolio global. We do not have one default in our portfolio. We've been told we're the only private equity firm that does not have a default, and that's all because of Tom and his team that have really gotten embedded in these companies. Cost reduction, new initiatives, what have you. So it's paid off in spades. And people ask me, well, really, what do you do? And I basically don't do much, but it's what I've done is I've made a number of great decisions in my life. It's all about the people that I've brought into the firm and hopefully given them a platform where they felt comfortable and at ease and could really use their great expertise to build the firm with me. But and that's really what it's all about, is the people and the partners, and including you, Andy. You have made significant contributions to the effort. And
well, thank you.
Andy was a big part of a. Well, thank you.
Jay, just to stay on this a little bit longer, why don't you give an example of one of the businesses that we built as part of our buy, build, and grow strategy?
Well, I guess one of the most prominent ones that is a matter of public knowledge, so I will use that, is JTP, which is in the telecom, datacom business. Now, we weren't in the sophisticated side of this. We were in the very mundane side. We were like provided parts, components, and supplies to all the telecom and datacom companies. And we kind of backed into it. We really didn't know. There was no great grand strategy. It just kind of worked out that way. And we had bought in, I forget when, 86, 87, a small company, and maybe it was later than that, in Middlesboro, Kentucky. Now, Middlesboro, I got to tell you, it's not the end of the world, but you can see it from there. And it was in just a pipe business. I don't know what the hell it was doing. Well, Tom had joined us by then, and he kind of figured out that, hey, wait a minute, there's more to it than just potable pipe or whatever. There's something connection here with the telecom business. So it grew and developed into a product called Interduct, which is a product through which they feed fiber optic cable. And with that, we bought other companies, fiber optic cable assembly companies, connector companies, what have you, electronic connector businesses, all mundane products, but all serving an industry that was growing 20, 25% a year. So we built this thing from, I guess, $1.5 million EBITDA up to a run rate of $100 million EBITDA over a period of time. And we're fortunate that we kind of figured out that the way the world was going to come to an end. And so we sold it in, I guess, January of 2000. And the world did not come to an end until June of 2001, and then it really came to an end. So that was kind of a classic buildup. It was as much luck as anything. We didn't really figure it out, what we had, until we were into it. But once we figured it out, we were able to scale it and very successfully.
I've been with you for 20 years, and
oh my God,
for the first 10 years, we never sold a business. And one of the reasons is that we didn't have a fund, so we could take our time, grow businesses. And yet, after 20 very successful years, in 2002, you and your partners decided to raise a fund. Why did you do that after 20 years of...
Well, now, where did this question come from, Andy? I'd never heard of this one before. Well, the market's changed, and it was a matter of capital. We were running out of capital. We had accumulated a lot of businesses that were not as liquid as we'd like them to be. We had just come out of the recession we're in the middle of the recession, really, 2000, 2001. Our portfolio was highly illiquid. We did not have the capital to continue to reinvest. And so we decided collectively as a group that, hey, we need to really get into the U.S. LP market and start to build a private equity firm that actually had a fund. We also had been bringing in a bunch of younger folk, many of whom are here tonight, and we had to provide a platform for them for the future. And when many of us have been reasonably successful and we had capital, but if you're bringing in the young guys, you got to give them an opportunity to grow and build within your firm, and you can't do that unless you have a substantial capital base that's available for them to do their thing. So that is why we did it. It was the illiquidity and the fact that we wanted to expand as a firm. The only way we could do it is to raise that capital.
Great. Jim mentioned you've been in this business 38 years. What changes in the industry have you seen during this time?
Oh, Andy, come on. What time are you shutting this thing down? Well, it's migrated from a candy store business, which it was when I started out, to a highly sophisticated global institutional dominated business, okay? It was much more entrepreneurial in the 70s. And as you progressively went through the 70s and through the 80s, it became very institutionalized. And now the basic business is really controlled by the institutions providing the capital for all of the private equity firms to invest. So it's very, very institutional. So it's gone from very entrepreneurial and kind of candy store mom and pop business to a highly sophisticated global. Nobody even heard the word global till the mid-90s or what have you. But now a lot of private equity firms have multiple funds, and they've got global funds, they've got regional funds, they've got whatever. So it's really grown up. Now, I don't know what the future will hold. I think there are going to be a lot of funds that aren't going to be around. I think there's going to be a lot of consolidation. The trend in the industry is for the brand name sponsors to have a number of multiple funds defined by size, whether it's large cap, mid cap, or small cap, location, whether it's China or India or Europe or Latin America, and by investment thesis and strategy, whether it's distressed or mezzanine or what have you. So you're going to see a big consolidation, in my opinion, and you're going to see there'll be a few specialty firms around, but there are going to be a lot of multi-fund, and there's about 50 today, 50 private equity firms out of maybe 2,000 that have multiple funds, and I think that's the trend in the industry.
Jay, you mentioned earlier that you've been through 5 recessions and economic cycles. Is this the worst cycle you've seen as an investor?
Well, this macroeconomic cycle was not as bad yet as 74, 75. The numbers were worse then, okay. But there are a lot more zeros associated with this one. You also have a situation today where you have a global financial potential meltdown. The capital markets are so highly leveraged today. They weren't leveraged back in 74, 75. And you never had derivatives. There were no such things as derivatives in 74, 75. They only began to emerge in the early 80s, and then the crescendo was probably in this last, the peak was in this last meltdown. Very, very frightening that you had a lot of leverage, and if we take the credit default swap market, you had $60 trillion of notional value of CDSs out there. You only had $5 trillion or $6 trillion of cash bonds supporting. It was like being in Las Vegas, and highly levered. Now they call it insurance contracts. Total nonsense. Insurance contracts, you have to have adequate reserves. There were no reserve requirements in the CDS market. It was all a little margin, but that was it. Number 2, you had to have an insurable interest. There was absolutely no insurable interest. There was $60 trillion of off-balance sheet leverage. It wasn't on everybody's balance sheet, and nobody knew where all these, who owed what to who. Scary, scary, scary. You didn't have that in 74, 75. And the global markets now are deleveraging, which they have to do, but so from a financial capital markets, this is much worse than anything we've seen. It may not be over, nobody knows, but fortunately, we think there's enough liquidity now that it's been stabilized.
What have you and your operating team done the past couple of years to help your portfolio companies manage the current recession and prepare for a future recovery?
Well, our firm, the OMG headed by Tom, as I mentioned before, they are busier now than probably they've ever been. And this is where they really earn their keep, because these companies need help. And a lot of them, their top lines are deteriorating, and it's all about cost initiatives and survival. You've got to get through the bad times. And fortunately, we're not over-leveraged. We're not big leverage folk. We don't use leverage to make our returns. We use leverage to enhance our returns, which is a big difference from a lot of our competitors. You'll see some firms leveraged at 8 and 9 times, and we don't even pay that kind of a multiple for the business. But our average multiple or leverage multiple today is probably under 3 or approximately 3, and where a lot of our competitors are awash with liquidity problems where their leverage factor may be 6, 7 times. So, as I stated before, Andy, the operation management team has really done an outstanding job. And again, the proudest thing that we have to say today is that in all of our portfolio companies, we have no defaults, and we may be the only private equity firm that can make that claim. And it's all a function of our OMG.
Okay, let's talk about China. We've done a lot internationally, and many of you may not know that we've done, the Jordan Company's done 24 investments in China since 1994. Acquisitions, joint ventures, greenfield startups. Why don't you talk about that, how it's progressed?
Okay, well, actually, Tom, you ought to be getting this award. all of our international or global activity has been directed under Tom's leadership, and particularly China. Back in the early 90s, we had had a discussion about perhaps establishing a beachhead in China, or toehold, or whatever they call it. And we hired a fellow named Yo Ming Yi, who was the first China person. And it built from there. He spent a year or so training with us in the States. Then he moved to China, and it all began there. And the peak is, I hope it's not the peak, but at least the most significant thing was that the company that we had bought 4 years ago in 2006 under Tom's leadership, IMM, our coal mining equipment business, just went public, and for a great price, and so we hope to have many more of those. But we've had a global impact. I think we've done over 60 transactions in 38 different countries, including Russia, India, Latin America, Eastern, Western Europe, Canada, China, and I'm sure there's others that Tom can tell you about that. But anyway, it's been a great experience, and we're the only private equity firm that actually conducts its global operation or its global investment as embedded in operations. We are an operations team globally, and you have to be. We're not the same kind of investor that we are just in the U.S. domestic market. Mm-hmm. We're not a private equity investor. We are a private equity manager investor, operations oriented, and particularly in China, you have to be.
What do you think about future opportunities in China and the movement of the private equity industry into China and Asia?
Well, Andy, you've done a lot of work in China, okay? You know it as well as anybody. You've been very significant. So let me ask you, what do you think about the future of China? Hell, I don't know. You can answer that better than I can. You guys are over there all the time. Lisa Andrelu, where's Lisa? She's here. She's been a great asset of ours in China. And she's starting to look a little Chinese, you know. So I can't really answer that. We're hopeful that we are going to continue to, I mean, the great skill set I believe that our team has is these SOEs, these state-owned enterprises, these huge messes. Because we're so operations-oriented, we know how to deal with them. We have a great relationship with the Chinese government. I think, and Tom can correct me if I'm wrong, that we're the only Western capital that's ever been allowed to buy 100% of a state-owned enterprise. We're the only folks that have ever been allowed to buy control of a strategic asset, which coal mining equipment and coal mining is a strategic asset. So we have great relationships with the folks in China. And as you know, I mean, Andy, I've seen you drinking Mao Tai or whatever it is you drink with the mayors of all these damn cities, you know, just to keep them happy. So you know more about it than I do.
What do you say to that, you know?
Marcia, that's a guy's son. He can drink any Chinese under the table. I guarantee you that.
I can ask for beer in 30 languages. You know, that's important. Right, Jim? Yeah. Switching back to the industry overall, what, in your crystal ball, how do you see the private equity industry moving forward?
Well, you know, obviously there's been a lot of issues, a lot of problems. There are a lot of firms that will go out of business that will not be able to sustain themselves through this cycle. As I had stated, there'll be a lot of consolidation, I think. And the trend has been in the industry that you'll have multiple funds under the umbrella of sponsors, and which the LPs love because it really saves them a lot of time in terms of due diligence. It's much more productive if you know the group that you've already vetted and you know how good they're, then you make a decision on the individual team of the other fund. Mm-hmm. But it's really a productive way for them to deploy resources. I think that's kind of the trend, and that's where things are going. So,
okay.
But I'm usually wrong, Andy. So,
is there anything, Jay, looking over the years, that you would do differently if you had the chance to do it again?
Well, on a deal-by-deal basis, yes. We've had some failures, obviously. You can't be in this business without failures. But in terms of people, absolutely not. We've brought into this firm the greatest folk in America to do what they do. And they're people that have great families. They're very bright and very intelligent. They come from different experiences. very compatible. The chemistry is terrific, and it's all about chemistry. You have private equity firms where everybody hates everybody. I mean, there's no compatibility at all. There's no chemistry at all. That's no way to run a firm. And if you look at ours, we've been told by our partners, our limited partners, that we have the oldest, longest standing group in the history of private equity. People have been with us for 20, 25 years. That doesn't happen if you don't have a great culture. So it's all about building a great culture, a lot of smart people, give them the opportunity to do what they do best, and leave them the hell alone. Don't micromanage them. But, you know, we do have investment committees and that sort of thing. But you get them out there and let them do what they do. I mean, hell, I remember when I was 28 years old, I was sitting across the table from the CEO of Clark Equipment Company and negotiating a deal. There's no reason any of our young guys can't do the same thing. If I can do it, anybody can do it. So the real issue that we have is trying to push down responsibility and get some of the younger folks out there doing the transactions without looking over their shoulder, and without letting them make their mistakes. That's just part of the deal. I made a hell of a lot of mistakes. So on a deal-by-deal basis, yes, there's a lot of things. There are companies that I wish we hadn't bought, but we did. We made a mistake. But we do have a very low loss ratio, and we've been told by one of the big gatekeepers in New York that we have the lowest loss ratio in our market segment in the industry. I don't know if that's true or not, but it's very low because we play defense. We play major defense.
Okay, I've got a whole bunch more questions here, but at this time I'd like to open it up for questions. And what we'll do is someone asks a question, I'll repeat it, and then Jay can
Well, I'll answer the first question. Yes, Notre Dame's Coach Kelly is still undefeated.
Okay, any questions? Craig, I know you got one.
Right. Is to become more value add, more operations embedded? Is to become more value add, more operations?
Yeah.
I agree with that.
Yeah.
I absolutely. I think the days of, and we've all experienced that in this last meltdown. It was all engineering, financial. There was no value add, and particularly the mega firms. They were buying these things, paying ridiculous prices, way over leveraged them, and adding no value at all. It was just a shell game. And you knew the music was going to stop, but you were hoping you could knock back enough money before it stopped, and it stopped in a big-time way. So you got to migrate towards that. I think I don't know who you're quoting, but I think that's 100% right. Now, whether that will happen or not, people have very short memories. And in this industry, as I've been around, you know, you go through these catharsis, and everybody forgets, and 3 years later, they're doing the same damn thing they did 3 years ago. I just read a shocking article that they're now doing these covenant-light loans and PIK toggle loans again, and everybody, billions. It's just remarkable. So I think they're right, but I don't think the industry will necessarily go in that direction. I think it's just, you know, greed and speculation is the game, and it's like being in Las Vegas.
Let me follow up. You've inspired a lot of the American private equity firms to follow your path. Do you see that in the European investment firms? Do you see it worldwide to have the operating aspect as well?
Well, you know, we're not really big in Europe. We do have some LPs in Europe, but it's a different model, and I'm not sure that that's really the operations side is a real model in Europe. And again, a lot of firms are migrating towards that. In the U.S., some of them are doing it, but I don't think any private equity firm I'm aware of has as sophisticated a team and as sophisticated leadership as we have in our operations. And we've been there a long, we've been doing it a long time. Doesn't mean we haven't made some mistakes, but you know, we've been at it for 22 years. Nobody's been doing it that long. There's somebody.
Yes. Make sure we repeat the question.
What?
Repeat the question.
Scott, you got to speak up. I can't hear you. I'm getting old. I got a Lifetime Achievement Award. Come on.
The question was, after doing 100 major deals, who's the best manager that you've seen, and what are the qualities of that manager to be successful?
Well, the best manager is Mr. Quinn. I mean, obviously, we brought him into the firm. No question about that. And the greatest quality he's got is he was my roommate at Notre Dame for 3 years. So. Scott, I don't know. I mean, that's a very, that's a very, they all have their unique ways of doing things, okay? There's no one right way to do anything, right? No one right, everybody's got their own particular deal. We deal with people that are ethical and moral and conduct themselves properly. Some, we hold them accountable. Some can perform, some can't, but they all have the various nuances and personalities. And the one thing you can never do, and we know that, is give a manager the responsibility to perform a duty and not give that manager, he or she, the authority to execute that responsibility. You cannot micromanage. And I know Tom, and I've watched Tom and followed him. The way he relates to these folks are beautiful. And he knows when to blow the whistle, and he knows when to let the leash go. And it's all about experience. And, but I can't tell you that there's anyone out in our portfolio companies. So.
Yes?
You talked about in the early days investing in old school industries and
Right.
those types of deals. Today, what are you looking to invest in? Where do you think the opportunities are?
We're investing in old school deals and those type of deals. That's exactly what we're doing. We haven't changed. We've gotten maybe a little more sophisticated in some of the healthcare stuff we're doing. We don't do really high tech. We do basic businesses. If you looked at our portfolio, it's pretty basic. Now we do have, we never really made a big play in healthcare to the last 4 or 5 years. And then one of our great partners, Adam Max, decided that healthcare is an area that we ought to focus on. Now we've done about 4 or 5 deals, Adam. I don't know how many, but there is a trend there, and it's worked beautifully. And Mr. Butler, he did a healthcare deal. So we never used to do healthcare back because we were stupid back in the 70s. And hell, if I knew anything about healthcare, well, that's all we'd have focused on. If you look at the growth rates, but we didn't really know what was much was happening. We were primarily in manufacturing oriented back in the 70s, but the whole economy shifted. It's now obviously much more service oriented. So you'll see our portfolio more in service businesses, but they're basic businesses. They're not complicated type stuff.
Okay, any more questions? Mr. McNair.
Well, it's pretty flat right now. The fundraising is very cyclical. As we know, the meltdown that really was precipitated by the Lehman bankruptcy and started in earnest in October of '08, all of the institutions experienced what's known as the denominator effect, i.e. they have an asset allocation model, and as the base shrinks, they get out of balance with their model, so they have to reallocate capital. And when the public markets got destroyed, they were way out of balance, underweight in public markets, so they had to shift some of their liquidity, the liquidity that they had, which was shrinking by the day, into other markets to rebalance. Now that's pretty much over with, I think, but it's still, and people have started to rebalance, and the world has started to look a little better. The liquidity of the big institutions has improved dramatically, but it's still a tough fundraising market today. I don't know when that's going to when it's going to clear up. There still are liquidity issues.
Mm-hmm. Okay. Yes.
It's not the great Larry Butel, is it?
The question was, what is your take on the basic manufacturing business of the United States?
Well, as you may or may not know, manufacturing is about 15% of GDP. We track it, and obviously all the economists track manufacturing in order to make all these great predictions about GDP. I think what's happening is we're outsourcing and offshoring a lot of the low value add components of manufacturing, and the more sophisticated are staying at home, which is the way it should be. That provides quality jobs for our workers as opposed to some of the basic stuff that they were doing before. You see the trend really moving much more service-oriented economy, and we all read the Institute of Supply Management data and economic data, but it's really focused on output and production and manufacturing. And I would say that we don't have a monolithic economy anymore. We have components of the economy, some of which have been growing very healthily through this down, like healthcare as an example. It's done very, very well. Energy, some components have done very, very well. And yet a lot of basic manufacturing has done very, very poorly. So I think the future here is high value add manufacturing. I personally don't believe that it's going to, at 15% of our GDP, it's going to get much bigger than that. And I think we're still going to be high value add in service, as a service oriented. We have to maintain a strong and solid manufacturing base, if nothing other than for national security reasons. We've got to be able to produce hardware and that sort of things. And I think we'll do that, even though manufacturing will get a little more technology. So we have to maintain a strong manufacturing base. But it doesn't have to be 50% of our economy, and it's not.
Any more questions? Well, Jay, that was very interesting. Thank you very much.
Thank you, Andy. I appreciate it. Greg, thank you.
Thank you.